Good afternoon. Welcome to the TheoTrade afternoon video. I am Blake Young. Today is May 9th, 2023, and today we're going to be discussing, will a higher CPI see a lower market? CPI, or Consumer Price Index, is considered probably the #1 inflation indicator. We believe that PCI is watched a little more closely by the Fed, which therefore has maybe a bigger outcome as far as predicting what the Fed is going to do. However, CPI is still probably watched more by investors and more by the markets than any other inflation index. And currently in this environment where we're still fighting inflation while trying to avoid recession, inflation data is critical. Now, comparing CPI to PPI, Producer Price Index, which will be released later this week, is usually a predictive tool paying attention to PPI for next month's CPI. So this month's CPI will really have no indication of what we can expect for PPI. But the question is, will CPI, which is expected to show higher growth this month, so a rising inflation pressure, rising rate, will that have a negative impact to the markets? Oversimplification here, CPI, rising inflation, means that things cost more. In addition to that, if things cost more and CPI is rising, does that mean that we're going to see another Fed rate hike in June? And if we do, then we should and will expect to see equities fall. Equities fall in direction of the rising rates, causing more expensive borrowing and therefore slower growth in the market, in the global market. We're down about 1% from a year ago. We're flat for the last 6 months. You can see there's really not a lot of growth here in equities, or in assets, as it were. So watching that inflation data coming in higher, does that justify more future rate hikes? Currently, we're not seeing that being priced in. And I brought this up in the main room and in the futures room today. We're not really pricing in a rate hike in June, but we are absolutely pricing in about an 80 to 90% probability of leaving rates alone in June. I want to look back to see what we saw in previous CPI reports, what we saw when it outpaced the growth expectation and showed an uptick month to month. But then we're going to do a comparison between CPI in the US and CPI in the Eurozone. To start, we're going to Forex Factor. We're going to go to the CPI data. I'm going to click on the little drawing or the graphs here to focus on the month over month. And then we'll get into the year over year in just a minute. So what I'm looking for is I'm looking for higher than expected, meaning the blue bar is higher than expected, higher than the brown, and higher than the previous month. That's what I'm looking for. Little spikes. Higher than anticipated, higher than the previous. Higher than anticipated, higher than the previous. Higher than anticipated, higher than the previous. That's what I'm looking for in this chart. And we can go back through here and say this was lower than expectations, but higher than previous. That's fine. But is this one. So we want to look at this one, we want to look at this one, we want to look at this one, higher than expected, higher than previous, and determine what we could have expected to see on those dates. Going back to May's reports, we'd go June's reports of last year, July's reports. Over here, we'd be looking out to October's reports, and then seeing what the chart did during the same time frame. To be able to see that, I have to go back, and I'm going to the SPX instead of the ES futures, looking back to the 3 years weekly. And we're just going back to see the times where we had that CPI not only beat expectations, but rise higher than the previous time frame. And if we went back, we'd see we were looking at May, and it's always that first full week. This would be May, and certainly we beat expectations, 2021, beat analyst expectations, and we were higher than the previous month. And what happened? We sold off. And normally, rising inflation would not cause this pullback. This is for the week. We've netted out a pretty solid range and 179 points down. We did net out about 50 points down off of that week, off of CPI. We look at the same one in June. Again, a sell-off. We look at July, and July's report is this week when we saw a sell-off. So all those weeks in 2021, May, June, July, they were all showing better than expected, better than the analyst projections, maybe better forecast, higher forecast, and higher than the previous month. And watching those numbers, May 2021 is one of the more significant ones. We're seeing that rising inflation and higher than expected being priced into rate hikes and slowing the market down. if we look over and find the next time, we'd be going out for about 4 out of 5 of the weeks that we saw higher inflation and higher rates, that we saw a pullback in equities, pricing in a rate hike. Now, as we zoom forward, we can jump all the way forward to June of 2022. And I'll just scroll over here. Oh, and I'm sorry, I missed one. February 2022, we also saw this reversal. So we're 5 out of 6. We go to June, and it's not this week, it's actually this week. Major sell-off. Again, we're 6 out of 7 times when CPI was higher than analyst expectations, and we also saw a rise from the previous month. Those have all been a pullback. In October 2022, it's always the first full week, which is this one. We've seen now 7 out of 8 CPI reports that if it came in better than expected or higher than expected and a higher rate than the previous month, that is seen a bearish move in U.S. equities. I will note that CPI in February and March matched expectations, but February was higher than the previous month, and you can see we saw a pullback. And March, this was actually the week that it happened, and so it was not a higher month than the previous month, but it did rise with expectations there as well. So we're probably about 95%, 90%, 95% that when CPI is higher than the previous month and at or higher than analyst predictions, then the market's going to pull back. But it goes beyond this. It connects to more. Remember that the CPI's Consumer Price Index, is the dollar's purchasing power for all things that you can buy. Whether you're talking about assets and equities, whether you're talking about grocery bills, whether you're talking about utilities, whether you're talking about a gallon of gas, whether we're talking about a chunk of gold, right? It doesn't matter. We're comparing the dollar to a basket of goods and services. Well, services are showing higher costs. We're seeing inflation move, and inflation is driving services higher, or income, wages higher. So the question is, are we seeing inflation compared to the Eurozone? Because the Euro-US dollar makes up 55% of the dollar index. If we're comparing inflation in the Eurozone compared to inflation in the US dollar, there's two things we're watching. Number one, it's purchasing power. And you'll hear purchasing power parity oftentimes. Not the PPP loans. This is purchasing power parity, meaning comparing one currency's purchasing power to another currency's purchasing power. And we've seen so much activity in the overnight price action during the European market in the US equities. This is important right now. If the dollar is losing its purchasing power because of inflation, but the euro is losing more purchasing power, then that becomes an opportunity to make a comparative analysis to determine who is losing more. And then we're taking the interest rate hikes out of the ECB and the interest rate hikes out of the U.S. Federal Reserve and ignoring that and saying, just show me its purchasing power. When the U.S. was dealing with less inflation than the Eurozone, the euro loses its purchasing power. When the euro fights inflation and it has less inflation, the euro gains purchasing power in comparison to the US dollar. Now I'm going to show you a quick math equation that you can do yourself anytime you want to do this. Now I'm going to show you this with the previous months and years. So I'm going to compare a year ago, and we're just going to look at the year over year. And to do that, we're going to make the assumption that we are going to see 5% inflation according to CPI. I'm scrolling up, and we're looking at the European inflation data. So this core CPI and CPI flash estimates, this is telling us that in the Eurozone, they're experiencing 7% inflation. In the US, we're assuming this next report is 5% inflation, right? 5% year over year. So what does that mean? Let's do some math. And I'll do different colors here. Let's try here. So what it's saying to me is that if one currency, the euro, is experiencing 7% inflation, that means the euro has lost 7% of its purchasing power in a year-over-year basis, which means from the year prior, it theoretically has 93% purchasing power than it was the year prior. The US, on the other hand, for the same time period, has a 5% inflation. That's an F, inflation rate, which means it's at 95% of its purchasing power from a year ago. Now, if we want to do some quick math on this, we'd divide 93 divided by 95, and that should tell us what the comparative move or the comparative purchasing power, not adjusting for knee-jerk reactions to rate hikes or rate changes or central bank shifts, but just simply looking at this from the view of what is the expectation of the difference in the two. And I'll move this over here just so it gives us a little bit of room. Now, theoretically, this means that if we took the 93 divided by 95, the Euro-US dollar should be trading at a 97.8% differential. So whatever the price was a year ago, if inflation data is accurate and its purchasing power against its own basket of goods reflects in its purchasing power across the board, then we should see a 97.8 value of what it was a year ago. Well, about a year ago from that original price. Now, we can use this to predict forward as well as backwards just to confirm. So we can use this and say, well, we need to adjust down. And as we're looking at this view, we're going to go back to May 8th and May 2nd, because that's the weeks that we would have seen it a year ago from both the European CPI and the US CPI, and we're at about 105.40. So if we take 97 and multiply it by 105.40, theoretically, the euro versus the US dollar should be at 103, 103.20. Where are we at? Currently, we're at 109. The balance, assuming inflation is accurate, the euro-US dollar should be down here at 103, 103.20. If that plays out, if inflation data shows 5%, less than 5%, now we already price it in as we go. That's one thing to keep in mind. But if we expect to see that same differential in the next year, then sometime in the next year we expect this to go down to 103. Now that may not seem like very much to go from 110 to 103, but 7%, 6% in the euro-US dollar is huge, and this is a weekly chart. Keep that in mind. If we drop back down to 103, that difference will equate to a similar inverse rise in the US dollar index. So dropping from here to here, let's go ahead and measure it as a percentage, and we'll do the same thing predicting it on the dollar index, and we're going to look back to November 11th. But if we saw that same drop down to 103.20, then we're talking about a 5.8% drop in the euro or 5.8% gain in the US dollar. And if we go over here, here's the dollar index, and it's comparative, remember. So if we see it go back to that November 18th, where's my November 18th? Right there, or 14th, excuse me. 14th, then we're going to be looking at a move from the dollar index here up to that price action, and we're talking about a move of about 5%. Now remember our correlations. If the dollar gains strength on the dollar index and we see a 5% rally, not only will that just create a Gartley pattern or harmonic pattern that looks like this, which is a double bottom, a little W pattern. We don't have to go to the previous highs. We're just talking about a bounce up here. That is a 5% gain in the US dollar compared to the euro, but a 5% gain relative to the counterparts, the euro, the pound, the Aussie, the New Zealand, and the yen. If the US is getting a gain or strengthening 5%, then we can expect indexes to go down 2 to 2.5 times, while the dollar goes up 5. Now we're talking about a drop of about 12.5%. Now that's individual indexes, 12.5% drop in indexes, and probably about a 25% drop on some individual stocks. So 12.5% drop in U.S. equities if the dollar is relatively stronger. It doesn't mean this inflation doesn't exist. It's that the dollar is experiencing 5% inflation while the euro is experiencing 7% inflation. It's that the dollar is experiencing 5% inflation while the Mexican peso is experiencing 11% inflation, while the UK is experiencing 8% inflation. It's the differential of its purchasing power, or the purchasing power parity, the comparative analysis between those two currencies. And we're getting that all from CPI and comparing one CPI to the other. So if this price pattern plays out, if the dollar finds support, if CPI comparatively gives the dollar strength, and we see that little move, which doesn't take a lot, we could see a 12% drop in equities. Now, that's not overnight. Keep in mind, this pattern, the time that it took to go down can be the same time it takes to go up. And if we were to say, let's do a very harmonic, consistent drop, that took 12 weeks. If this is the base today, and we're going to rally over the next 12 weeks, we could be going out to July, end of July, first week of August. We're talking 12 weeks. By end of July, early August, we could see a 12.5% correction in U.S. equities. Let's go back once more to the SPX and look at this as the indication. If the inflation data kicks in, could this be resistance? Could this be a setup for a double top? Could we see a 12-week pullback that is equivalent from our current price, a 12-week pullback that is equivalent to about 12.5%? Look where that puts us. Over 12 weeks, end of July, we should see 3,600. That would just be a price pattern. It'd be a double top. It'd be a pullback. This move up could easily turn to this move down, and that's all that's doing is finding the previous support level. That is not catastrophic. It is a correction. It is the sell in May and go away. Where are we? We're in May. So just be aware of that. CPI is set up to give us a bearish move. If inflation is running hot, and hotter than expected and higher than the previous, which it's set up to do, and comparatively the US dollar is experiencing inflation but not as much as other currencies, that is the recipe to see the SPX pull back 12.5% over 12 weeks, so about 1% on average per week. And that's what we're going to watch for. So be very careful tomorrow. We could see a lot of volatility. We could be surprised, but it is appearing that we're going to see higher inflation and setting us up for a potential pullback by the end of this week. Have a great day, and we'll talk to you again next week.